All right, so we're diving into your research today on these top stocks for long-term investment. And looking at October 2024 specifically, it looks like a lot of the sources we have are really focused on a few key sectors. We've
Mm.
got tech, a little bit of financial services, even just a touch of consumer goods. Now, obviously,
Yeah.
nobody can predict the future perfectly when it comes to stocks, but it is super interesting to see the logic behind why these companies are being recommended right now.
Yeah, you hit the nail on the head there. It really is all about understanding the why. And when you see these clusters around specific sectors, it tells you something about where the market seems to think the long-term growth is going to be.
Definitely. So let's start with what feels like the default setting for long-term growth, at least when you look at a lot of these lists. And that's these tech titans, right? I mean, Amazon, Alphabet, Microsoft, they're almost always at the top. But what's the real logic there? What makes them so consistently recommended?
Well, it's more than just riding the wave of tech in general.
Hmm.
These companies are really shaping the wave.
Okay.
And you can see that in their investments. They're all in on AI, they're all in on cloud computing, but it's how they're leveraging these technologies
Right.
that really sets them apart. I mean, take Amazon, for example. Everybody knows them for e-commerce, right?
Right.
But it's their cloud platform. Amazon Web Services, or AWS, as it's often called, that's a real game changer. You've got this massive chunk of the cloud infrastructure market
Hmm.
that they control. They're providing services to everyone, from tiny little startups
Hmm.
all the way up to huge government agencies. And that gives Amazon this incredibly stable revenue stream that's totally separate from the retail business.
Yeah.
And it's just growing rapidly.
I mean, it's amazing to think about how they've become such a dominant force
Right.
in a field that's, relatively new. It's not just about having the technology. It's about understanding how to apply it on
Yeah.
this huge scale.
Exactly. And then you look at a company like Alphabet, Google's parent company, and they've got this incredibly solid foundation
Yep.
with their search and advertising business, right?
Mm-hmm.
But they're also pushing boundaries
Mm-hmm.
in all these other areas. AI, of course, cloud computing with Google Cloud. They're even in the autonomous driving game with Waymo.
Oh, wow.
So
Yeah.
it's this really diversified approach, and they're constantly expanding into new markets. It makes them a really strong contender for long-term growth.
Yeah, it's like they've got their fingers in every pie, but they're actually baking the pies really well.
Uh-huh, right. And then, of course, you can't forget about Microsoft. I
Yeah.
mean, they've been a tech giant for decades,
Mm-hmm.
and they're showing absolutely no signs of slowing down. I think it's really smart how they've shifted their focus
Yeah.
to cloud computing with their Azure platform,
Right.
which is now a major competitor to AWS. And on top of that, they still have those legacy software businesses,
Yeah.
Windows, Office, all of that, which continue to generate huge amounts of revenue. So you've got that blend of established products and these forward-thinking strategies, and it's keeping them incredibly relevant.
I mean, all these companies, really, they're not just writing on their past success. They're actively shaping the future of tech. And it's fascinating to watch. And we can't talk about tech without mentioning Tesla. It is on your list of potential investments here. But it definitely has a bit of a different flavor than these other tech giants we've been talking about. What makes it a riskier but potentially higher reward play?
Well, Tesla's all about disruption. And while they are heavily invested in AI, like the other companies we were just discussing, their core focus is really on those electric vehicles
Yeah.
and sustainable energy,
Right.
which makes them a much more specialized play compared to those diversified giants, like an Amazon or an Alphabet.
Right.
And what makes them so intriguing, but also so risky, is their current push for fully autonomous driving technology
Mm-hmm.
and these ambitious robo-taxi plans they have.
I was just reading about how also they're developing their own AI chips, specifically designed for self-driving. I mean, if they can actually crack the code on that.
Okay.
On autonomous driving, it could completely revolutionize transportation.
Absolutely, and that's the allure of Tesla. They're aiming for this complete transformation of an entire industry. But the path to that is paved with, these huge technological hurdles and regulatory challenges. If their vision succeeds, the payoff could be enormous, but the risk is equally substantial.
It's like this high-stakes bet on the future of transportation.
Exactly. Now let's shift gears a bit from the world of cutting-edge tech to the more established realm of financial services. We've got JP Morgan Chase as this sole representative from this sector, and it might seem a little bit out of place next to all this tech buzz we've been talking about. But why is this a stock to watch, specifically as we head into the fourth quarter?
Yeah, I'm curious about that too. What makes JP Morgan Chase stand out in this particular time frame?
I think it all boils down to two words: interest rates, the financial sector, and especially a banking giant like JP Morgan Chase. is very sensitive to interest rate adjustments, and we're expecting some key announcements. Q4, their upcoming earnings report, should give us some real insights into how they're navigating the current interest rate environment and what their strategy is going forward.
So even if somebody isn't, deeply involved on finance, just understanding how interest rate changes can impact a company like JP Morgan Chase can be really valuable. It's a good reminder that different sectors react to economic shifts in totally different ways.
Precisely. And it's not just about their lending activities. It's about their entire portfolio of financial services, including trading and investment banking. These interest rate fluctuations can have this ripple effect across all those different areas.
That's helpful context for sure. It really connects the dots between these larger economic forces and how they can actually impact individual companies and ultimately investments.
Exactly. And speaking of connecting dots, let's not forget that. Your research really emphasized choosing stocks based on your individual risk tolerance. And we've got a pretty diverse mix here, from those established giants like Amazon and Alphabet to the more volatile Tesla and the interest rate sensitive JP Morgan Chase.
That's a great point. There's no one-size-fits-all approach to investing. We've explored the logic behind these specific recommendations, but understanding how they actually align with your personal risk profile is absolutely crucial.
Absolutely. We need to delve deeper into this whole idea of risk and reward and help you, the listener, think about how to balance these recommendations with your own investment goals. And we can get to that right after a quick break.
All right, sounds good. All right, so we've laid out some pretty compelling arguments for these top stock picks, but now it's time to talk about how they actually fit into your personal investment strategy. And a big part of that is figuring out your own risk tolerance. So how can somebody go about assessing their own risk profile?
That's a great question. And it's really the foundation of smart investing. A good starting point is to think about your financial goals and your investment time frame. So what are you actually investing for? Are you thinking long-term, like retirement decades down the line? Or are you saving for something a little more short-term, like a down payment on a house in a few years? Or maybe it's something else entirely. Your goals and your time frame are going to have a big influence on how much risk you're actually comfortable taking.
Right, that makes sense. I mean, somebody with a longer time frame, they might be more okay with the ups and downs of a really high growth stock, even if it's potentially volatile, like a Tesla, for example. But if you have a shorter time frame, you might be prioritizing more stability and consistent returns, even if the potential gains aren't quite as big.
Exactly. And it's not just about time either. It's about your own personal comfort level with risk. Some people really thrive on the excitement of potentially big wins, even if it comes with the possibility of losses. Others really prioritize protecting their capital, and they prefer investments that offer more steady, predictable growth. And there's really no right or wrong answer here. It's about finding what aligns with your personality and your financial circumstances.
And this kind of brings us to another important concept that came up in your research, and that's diversification. I mean, you've got a mix of companies here across different sectors: tech, financial services, even a little bit of consumer goods. And that seems like a good starting point for building a diversified portfolio. Can you talk a bit more about why diversification is so important?
Sure. Diversification is really all about managing risk. The basic idea is that by spreading your investments across different asset classes, different sectors, even different geographic regions, you're reducing the impact of any single investment performing poorly. It's like that old saying, don't put all your eggs in one basket.
So even if somebody is super excited about the potential of tech and they want to invest really heavily in that sector, it's still wise to diversify and include some exposure to other areas of the market.
Absolutely. Tech is exciting. It's got this history of strong growth, but it is prone to these cycles of boom and bust. And by including other sectors in your portfolio, you're creating this buffer against potential downturns in any single area. So if tech takes a hit, your investments in financial services or consumer goods might help offset those losses.
It's like a safety net for your portfolio. Helps smooth out the bumps in the road. Now let's go back to those specific stocks we were talking about earlier and how they might fit into a diversified portfolio. We've got Amazon and Alphabet, both leveraging AI and cloud computing in some really innovative ways. Then there's Tesla, that electric vehicle disruptor with that high risk, high reward potential. And then, of course, we've got JP Morgan Chase, that financial stalwart, navigating these changing interest rates. What are some of the key things that somebody should be thinking about if they're trying to figure out which of these align with their own investment approach?
Well, that's where things get really interesting and where understanding your risk tolerance becomes super important. If you're somebody who's comfortable with higher risk and you're drawn to companies that are really pushing boundaries, it's those companies that are innovative, Tesla might be a really compelling option. But it is essential to remember that Tesla's success hinges on actually achieving those ambitious goals, like fully autonomous driving, which is still very uncertain.
Right, it's a gamble for sure,
Right.
but one that could pay off big time if they succeed. What about Amazon and Alphabet? They seem like more established, maybe less volatile options, but are there still risks to consider there?
Even with companies as established as Amazon and Alphabet, there are always going to be risks. I mean, competition is fierce in the tech world. New technologies emerge all the time, and those can disrupt even the most dominant players.
However, both Amazon and Alphabet, they've shown this remarkable ability to adapt, to innovate, and that makes them much more resilient to those potential disruptions. Plus, they both have these incredibly diversified business models, which further reduces their vulnerability to any single market shift.
So while they might not be as volatile as Tesla, it's still important to be aware of that competitive landscape and the fact that the tech industry is constantly changing. Now let's talk about JP Chase. It's the only financial services company in this mix. We talked about how interest rate changes can really impact their performance. What should somebody be considering if they're thinking about adding JP Chase to their portfolio? Well, JP Chase represents a totally different kind of investment. It's what's considered a blue chip company, meaning it's large, well-established, and financially sound, with its long track record of stability and profitability. However, their performance is really closely tied to the overall health of the economy. And as we discussed, those interest rate fluctuations.
It's important to understand those bigger macroeconomic factors and how they might influence JP Chase's performance. It's a good reminder that investing isn't just about picking individual companies. It's about understanding the whole context that those companies are operating in.
Precisely. And I think that's a really key takeaway for our listeners today. Investing is a journey. It's a journey of continuous learning and adaptation. It's about understanding your own risk tolerance, doing your research on companies and sectors that align with your goals, and staying informed about the economic and technological forces that are shaping the market.
That's a great point. It's not just about picking stocks and hoping for the best. It's about developing a strategy that's well-informed and that you're constantly evolving.
Exactly.
So with that in mind, let's move on to the final part of our deep dive, where we'll explore some of these broader trends and leave you with some thought-provoking questions to consider as you continue your investment journey. Okay, so we've covered a ton of ground today, from the logic behind these specific stock picks to how to think about risk and reward and diversification. But before we wrap up, I kind of want to shift gears a little bit and zoom out to look beyond these individual companies.
I think that's a really important step in the investment process. It's easy to get so focused on the hype surrounding these specific companies. But the people who are really successful at investing are the ones who can spot those broader trends and understand those larger forces that are shaping the market.
So thinking about those broader trends, what are some of the key takeaways from our deep dive today? We spent a lot of time on tech, and it's clear that AI and cloud computing are huge drivers of growth and innovation there. Are there other trends, maybe within tech, or even in other sectors that are worth paying attention to?
Well, absolutely. I mean, even just within tech, you've got these incredible advancements happening in areas like virtual reality, augmented reality, and the Internet of Things, all of which have the potential to totally transform how we live and work and interact with the world. And that's going to create a whole bunch of new markets and new investment opportunities.
Wow, we're right on the edge of this whole new technological era. It's exciting. Think about it.
Which companies are going to emerge as leaders there?
Yeah.
What about outside of tech, though? Are there trends in other sectors that might be worth exploring for long-term investments?
Definitely. One area that's getting a lot of attention lately is sustainable investing. You've got investors who are looking for companies that aren't just profitable, but are also committed to things like NETs, environmental, social, and governance principles, or ESG as it's often called. And this trend is driving investment in renewable energy, clean technologies, companies that are really focused on social impact.
That makes a lot of sense. It's not just about financial returns anymore. It's about aligning your investments with your values. Exactly. And we're also seeing huge growth in fintech, which is short for financial technology. These companies are using technology to disrupt traditional financial services and offering some really innovative solutions in areas like payments, lending, and wealth management.
So fintech is kind of blurring the lines between the tech sector and the financial services sector. It's a good reminder that these sectors don't operate in isolation. They're constantly influencing each other.
Absolutely. And that interconnectedness is something to really keep in mind as you do your own investment research. Think about how different sectors might converge and how that might create new opportunities or even new challenges. Like how could AI and machine learning totally transform healthcare? Or how might blockchain technology revolutionize supply chain management?
Those are really interesting questions. It's like you've just opened up this whole new layer of the deep dive, encouraging us to think beyond just these individual companies.
That's exactly what I was hoping for. The world of investing is dynamic. It's constantly evolving. And the key to being successful is to stay curious, to keep learning, and to be open to adapting your strategies as new trends emerge.
Couldn't have said it better myself. So to our listeners out there, keep doing your research, ask those thought-provoking questions, and make those informed decisions that align with your goals and your risk tolerance. Remember, this deep dive was really just a starting point, a way to spark your curiosity and guide you on your own investment journey.
And remember, the people who are most successful at investing are the ones who are always learning, always adapting, and evolving their strategies. Happy investing, everyone.
That's a wrap on our deep dive into the world of long-term stock picks for October 2024. We hope you found this conversation insightful and engaging. Until next time, keep seeking knowledge and diving deep.